Hey guys, this is Mubashi and today we are going to analyze the Epack of Prefab Technologies. Because I am going to analyze this stuff because I just saw that in one day it has gained around 15.73%, and within a week it has gained only 31.31%. So as you can see, it has gaining it is quite in momentum. So that's why I decided to analyze this stuff. So let's start with it. I'm going to analyze it is technicals and fundamentals too. So let's start with the technicals. So EPAC. Okay. So basically, this stock is recently launched, as you can see here. Look at this chart. Initially, it was in consolidation. We can see that it was in consolidation here from this level to this level. Look at this, it was in consolidation before that, and now it has begun its consolidation here, and now gaining too much value in recent events, right? And after we can see that within we can say within a week, so it has gained around the 38%. That's too much, right? So let's go with these fundamentals. We pack. One thing is very notable here that when most of these stocks which are newly launched in the market, after I mean in IPO periods, whenever they launch in the market, they gain too much value, and afterwards they go down, or either in consolidation and slightly go up. But here we can say it was initially going like consolidation. After that, it has gained too much value, right? That's quite weird. Anyways, so now let's analyze it is fundamentals. As you can see, the market cap is only 2698 crore. So basically, it is a small cap. We can see that it has only value market cap of 2700. So let's see what the company actually do. Incorporated in the February 1999. Okay, Epack Prefab Technologies Ltd is one of the India's leading players in pre-engineered building. Okay, and prefabricated construction industry. Okay, basically they are in the construction industry. Okay. Business profile: the company provides the complete Turkey prefab solution covering design, engineering, manufacturing, supply, installation, and erection and of pre-engineering steel buildings, modular structure. Okay, modular structures and related components. It operates in the both domestic and overseas market, catering to industrial, commercial, infrastructure, and institutional segments. Okay, that's quite good. Because of the infrastructure development in India, and we know that the per capita is in India increasing, they are going to benefit from that. And also, as we know that the GST 2.0 has come in the picture, and because of which the consumption is increasing, so it can benefit them too. Okay, prefab business, EPS packaging business portfolio. Okay, manufacturing facility Greater Noida, sandwich panels unit Rajasthan. Okay, okay, that's it. Capacity utilization Greater Noida 67%, plus 62%. Here it is too much less, and sandwich panel unit. As per their we can say as per their business model, it is quite good. They are quite good utilizing their capacity. Okay. Geographical revenue bifurcation and north and central 33%, west 32, south. Obviously, north and central will be the greater. Okay. So east only 11.4. Okay. So basically, stock P is 36, and the industry is also the same around. Return on equity and return on capital employed are quite acceptable. We can say quite good. Promoter holding is quite good. They have a confidence in their own business. Interest coverage is quite low. Also, I don't prefer this company which have a interest coverage ratio less than the 8, because as per my knowledge and the past history which I have shown that whatever the company is, they should have more than the interest coverage ratio of 8, at least 7. That's why I prefer 8, because if some bad condition happen, they are not able to generate that much revenue, because it leads to the lower sales, and they are not able to collect that much cash, and that leads to the they are not able to pay their interest obligation. So overall that leads to the more interest burden for the next year, next quarter. So that leads to the bankruptcy for the company. That's why I don't prefer this kind of companies. Okay. EPS growth for the 5 years is quite too much negative. That's why I don't prefer this. Quick ratio is quite good. Current ratio is also good. And current price is book value is not given here. Return on equity. Okay, I already equity. Debt equity is good, but the interest coverage is not good. That's why. Okay. Sales growth for the 5 years is quite excellent. EBITDA, it is a capital intensive industry, so it is quite high, not that much, but it's still high. And PEG ratio is quite good. We can say too much, that's good. So okay, so let's quickly compare with this in the peers. Okay, quarterly sales variance is quite excellent. PEG ratio is also good. EPS for the 12 months earnings is very low. That's not good. Sales variance for the 5 years is excellent. Profit variance for the 5 years is also excellent. Interest coverage ratio is good. It is not good as per my we can say experience. Okay, EBITDA is acceptable, not good. Current market price sales is good. Return on equity and return on capital employed is also good. Pledge, there is no pledge. Debt to equity is good, but they are not able to pay their interest obligation effectively. As I already told, I expect them to have at least interest coverage ratio of 8. P is quite excellent if you compare with the peers. Okay, let's quickly analyze these quarterly results. As we can see, from 270 to 434, within 1.5 years, they are quite able to generate around 40% more sales. That's good. Okay, expenses, employee cost is the major cost which they have to incur, right? And as I can observe, they are quite doing best here. I mean, they are slowly efficiently able to reduce that cost. Employee cost, material cost. Okay, and employee cost is quite stable. Because of this thing, because of the material cost, they are efficiently able to minimize that, and that leads to the increase in the operating profit margin. As you can see, they have very less interest obligation, but still they are not able to generate that much profit, as we can observe here. That's why they have very less interest coverage ratio. Now let's and yes, we are from 13 crores to the 29 crores. So that's quite good. We can say it is because of the increase in the operating profit margin, they are efficiently able to generate around 120% more profit within 1.5 years. That's good. Profit and loss statement. Okay, from 245 to the 1100 crores. It is very, we can say 5 times approx. It is around 5 times. Within 5 years, they are able to generate 5 times more sales. Okay, you can see it is continuously increasing over the years. That's quite good. Expenses and material cost remain the major thing, and looks like their material cost has been increasing, so that's going to reduce the operating profit margin. Raw material cost is the major cost here, obviously. Manufacturing cost, they are efficiently able to reduce the manufacturing cost. Employee cost also remain stagnant, we can say. Other costs, they are also able to reduce other costs. But the material cost, raw material cost is like has been increased over the years. Okay, that leads to even though they are efficiently able to reduce the other costs and the manufacturing cost, but still they are not able to increase the operating profit margin, but at least it is not decreasing. That's the good thing here. Interest coverage ratio, interest is obligation has been increasing over the years, so their business has been expanding, right? Net profit from 11 crore to the 16 crore. That's excellent. Now let's analyze the balance sheet. Okay, reserves have been increasing exponentially. That's good thing. Borrowings, long-term borrowings are are not the major player here now. Short-term borrowings are the major player here, so it is quite good. Okay, fixed assets, as we can see, they are continuously purchasing fixed assets. They are increasing their fixed assets. There is also a current capital work in progress was there, and now it has been increased. You can see that investment. Okay, they are not doing that much investment. Trade receivables. Okay, this is the major concern here. It is a capital intensive company, so we can. It is a normal thing to that their trade receivables have increased, right? The thing is that I mean, receivables are over 6 months is the major concern here, but they are less as compared to receivables under 6 months. So it is a good thing. Cash and cash equivalent is good. Okay, loans and advances are also that's good. So let's check the actual cash flow, cash in and out in the company. So cash from the operating activity shows that whatever the capital profit which is company getting from the day-to-day business. Okay, within 3 years they are able to generate to 74, 76 and 130 approx. 130 crores of profit they are able to generate in 3 years. Right? Okay, 130. Okay, so 80, 130 and 30, 160 approx. So basically they are efficiently able to collect the cash. That's the good thing here. And the cash from the investing activity where the company is investing, like as I told you, that they are continuously doing expenditure in order to buy assets, right? Fixed assets sold, there is very less. Okay. Cash from the financial activity from where the company is getting the money proceed from share, 126 crores. That's okay. Proceed from the borrowings, we saw that they are having short-term borrowings more. Okay, ratios, debtor days are being expected little bit increase. Inventory days is been increasing. Okay, days payable also increasing. That's a good sign. That leads to they have very less cash conversion cycle. That's a good sign, because the cash conversion cycle shows the for how many days the net working capital, that is the current assets minus current liability, is time and the business. Basically the formula is say net working capital days, net working capital divided by the sales into 365. So it is good. Only 36 days their company's net working capital is trapped in the business. Okay. So there in shareholding there is no major thing here, nothing to see. Okay. Let's see, is there any importance going on? Receive material purchase. Okay, final review of the quarter end. Okay, is there any resignation? No. Okay, let's see what the credit rating they have got. A plus, that's good. Okay, so overall the company is doing quite good. We can see, if you want to invest for the long term, it can be a very great option for you. But before that, I would suggest even that wait for the company make more profit, so that their net interest coverage ratio increase, so that it will be the safe investment for you. Okay, and I am also not the SEBI research analyst. So yes, thanks for the investing. Sorry, thanks for the watching. Have a nice day.